Thank you, Richard, and thanks for having me here. I've been asked just to put up a few statistics just to create a little bit of context for the panel discussion that's going to happen. Just before I do that, I'll give you my stock answer when asked, how is the market now? And that is functioning but fragile. Functioning in the sense that transactions which were agreed are generally closing. Not all of them, but most of them in our experience. But fragile in the sense that it's very difficult for right now for sellers to engage or present something to the market is how they feel. And it's even more difficult for buyers or investors to actually underwrite their deals. And that's particularly the case when we look at funding transactions, not least because of the inflation of costs and the ability to actually build something now at a known cost, but also in standing assets as well, particularly related to the interest rates. Most of you will know that the 5-year swap rate has been moving every week for the last 6 weeks. And if you were in a deal, as many of us were 6 weeks ago, by the time you actually come to try and do the debt or actually agree the remaining terms, the cost of that debt has changed dramatically. And frankly, it's not that buyers don't have the appetite to buy Central European real estate. We don't see that at all. We see everybody maintaining their status that they have an appetite and they have the capital. But if you can't underwrite how much money you expect to make, you can't get a deal done. And by the way, for some, that may mean that we're happy to underwrite and make a little bit less money with slightly higher debt. I think that's particularly the case in Central Europe, and I think it has a competitive advantage with that, which we'll probably come back to at some point. But even if you're prepared to make a little bit less, if you don't know how much that is, you can't do a deal. So that's the fragility of the market. And the question is, how long does that fragility last? We've had it for a couple of months. My personal feeling is I don't think it will go on for another 6 months, but I do think we'll have 6 months where we'll have fewer deals done, which is frustrating, having had 2 years where there's been significantly lower volumes, particularly for our side of the business where we need those transactions. So I'll put up just a couple of slides. Do I need to point this in a certain direction?
Yeah, just point it at me, it'll work. There we go.
So these are just very basic slides with some very basic numbers covering volumes, capital values, and a couple of themes. So you can see on the top graph there that volumes in Central Europe, this is Central Europe entirely, has grown consistently right up to 2019 and then dropped significantly for 20 and 21, as you would expect. What's interesting about that is that the composition of it has changed quite dramatically. Retail has dropped very significantly as a proportion of those amounts. Office has also dropped, and industrial, which is the red part of it, has obviously become the dominant force. You can also see residential featuring there as well for the first time, which is largely forward transactions, which is a notable thing to say, which also might be worth coming back to. As for 2022, the first quarter was actually very positive. We had some really quite significant deals done, not least the largest office transaction, which was the Hub, which was purchased by Google, which is also a huge statement on occupier confidence in Warsaw, and several other transactions as well. So if you include a corporate deal, I think it's 2.5 billion for the first quarter, and then suddenly we've had a bit of a slowdown, as you'll appreciate. We genuinely felt that volumes would start climbing back towards 2019 this year. We genuinely don't feel that'll be the case now. Also, just to touch on some of the countries, Poland also, as you would expect, has consistently been 50 to 60% of the share of Central Europe. Worth mentioning Hungary and Czech Republic, which generally over that time frame has actually reduced slightly. and probably for two different reasons. I think both are relatively small markets naturally, but Hungary never really had the same proportion of international money coming back into it after the global financial crisis. Whereas Czech has shrunk almost purely because it just doesn't have enough product. It's the demand is there, it's just too small a market. The planning system is very difficult in the Czech Republic, so the product's not being built. I also put this statistic on the bottom up because it surprised me a little bit when I dug into it. The actual proportion of capital flowing into Central Europe as a proportion of Europe generally has shrunk over time. And if I asked the room full of people, do you think it would have gone up over the last 10 years as a proportion, you probably would have said yes, but it hasn't. And I think there's a couple of reasons for this. There's probably lots of reasons for this, and I don't think it's because Central Europe is not attractive, and I don't think it's because Central Europe is not attractive now. I think it's partly because most of the money in the market is now pan-European, whereas pre-global financial crisis, there were more bespoke funds for just Central Europe. I also think that it's the age-old problem with Central Europe, which it doesn't have enough of the right product. The demand from investors is there, but it doesn't have enough of the right product. And I'll give you an example of that. If most investors will come to my office and ask, can I have a core office building, probably brand new, probably between 60 and 120 million euros in lot size, probably has 4 or 5 tenants. Those tenants are probably pharmaceutical, tech, and other blue chips. And normally what I have to say is get in the queue, and it goes around the block, because there simply isn't enough of that product. It's fantastic that we've built skyscrapers in Warsaw, and there have been deals that have been done, and that's great, but it's more difficult to sell a 500 million euro building than it is a 100 million euro building. Am I still pointing at you? I purposely put up capital values rather than yields because we're all a bit obsessed with yields, and I think price per square metre is becoming more and more important, and even more important now when we look at the cost of actually building product. The snapshot is that offices, and I'm just focused on offices and industrial here, 54% over approximately 10 years, and industrial 120, most notably heavily concentrated in the last few years. And then conversely, and this is where I think it gets interesting, regardless if it's saying 4%, which is negative in real terms, 23% for rents on industrial, which is negligible in real terms, frankly, rents have been flat. And I think that tenants in Central Europe, which have been fundamentally really good economies over that time period, that have created a lot of jobs, and yet no tenant has been asked to pay more money for their space. I think they've had it too good too long, and I think the circumstances we have now are probably going to, I hope, fairly sure, are going to create a change in the relationship between landlords or developers and tenants, so that there is a more robust relationship which will probably dictate that tenants are paying more, particularly the case in industrial, which we'll come on to. So last slide, and then we'll move on to the panel. So just two simple themes. In industrial, the demand, which in our view is not going to reduce substantially, even if there's a recession, we think it's so high. And to put that into context, I think last year aggregate demand in industrial was 7.5 million, close to. And if you were to calculate it per capita, that would be way highest in Europe. In absolute terms, it's, I think, second in Europe after only Germany. And I don't think that's going to change, but even if it drops to 5, it's still huge. My question really, and probably the question for the panel, will be, how do we actually build that? And if most developers, from my conversations, are saying, we have problems with contractors, we have problems with materials. It's not just about the cost, it's finding somebody to do it. So I just don't see how we can keep volumes up, which also only means increased rents as well. The position in Warsaw offices is less clear, but nonetheless, the supply of new product relative to, let's say, new demand is still lower than it was previously. So I think that pressure exists in offices. It's less obvious, but it does. And the only caveat to that is, and perhaps to both these, is the proportion of costs that occupiers are paying as service charges, which will go up hugely as well. So, but otherwise, the gut feeling is that, particularly in industrial, and I think we're already seeing it, tenants will be able to pay more. I've also put their interest rates, which I mentioned earlier. The reason I think they're important, and not just the euro interest rates, but also the local interest rates, they're important for the resi market, which puts that under real pressure if you're financing in local currency. There simply is no yield premium, no yield gap. But also, the office market in particular has quite a high concentration of capital that comes from Central European sources. And at least half of that capital today is probably 40% of the entire market, particularly for core plus offices. And at least half of that capital comes from retail collections of money. And when those customers can get 5, 6, maybe soon 7% interest rate in their bank account, I think there's a real risk that that income, that capital will dry up. And if it does, then the office market may struggle, unless new Germans come in and replace the Germans at the minute that are less there, which may also be the case. And then, just as a final point, regardless of all these circumstances, I'm very positive on Central European property, not just because I earn my living in it, but also because when we're looking at those prices per square metre, it's still cheap relative to Europe, particularly in industrial still. And that's the metric that increasingly investors are taking account of. And also, if interest rates are higher, there is much less arbitrage between a 3% office building in Munich and a 4.5% office building in Warsaw. It can swallow that increase interest rate. So a couple of things to talk about, and that's it for my intro and stats.
Great. Thanks very much, Jeff. Really interesting. Thank you. Grab a seat, and I'm too close to the speaker, which is why I need to be across here. Good, yeah, so really interesting. So for the rest of the panel, if everybody could come up, that would be great. So we've got Angelus, if you're there, do come up. Sabina, obviously you're here as well. Robert, thank you. Asem, thanks very much for joining us online. Excellent. Can you hear us? Can we hear you though, Asem? That's the...
Now you can.
Now we can. Perfect. Yeah, that's great. Very good. That's great. Let's just start with very brief introductions. Let's just start with you, Angelus, and then we'll work our way around. So just a quick kind of 30 seconds on who you are and what you do.
Richard, I'll try. Thank you. So my name is Angelus Bernreuter. I'm with Kaufland International, Head of Investor Relationship Management. Kaufland is part of the Schwarz Group, which is one of the global leaders in food retailing. We run about 1,350 hypers all across Europe, with a strong focus on Germany and, of course, the CEE region. And the good news is we're still hungry to expand physically.
Perfect. Thanks very much. Adrian.
Hello, Adrian Karczewicz, Skanska Development Europe. I'm responsible for transactions in the region for Poland, Czech Republic, Romania, Hungary. Thank you.
That's great.
Yeah, Robert Martin. I'm one of the partners at Europa Capital. We're a pan-European investment manager. We have core funds and value-add funds, and have been investing in this region for over 20 years.
Sabina Reeves, Head of Insights and Intelligence at CBRE Investment Management, with a strong presence in Polish, Czech Republic, and a little bit of weirdly Slovenian logistics, and a touch of office in all three, plus Hungary.
Great, thanks. Assem, let's come to you.
Yes, my name is Asmar Rami. I'm head of the international origination of Berlin HIP. We also are active in Poland, but actually principally only in Poland when it comes to CE, occasionally in Czech Republic.
Great, thanks very much. Robert.
Robert Dobrzycki, I'm CEO of Panantoni in Europe. Panantoni is industrial logistic property developer out of US.
Brilliant. Victor.
Victor Constantinescu. I'm the managing partner of the Bucharest office of Kinsteller, which is a regional law firm with offices throughout Central and Eastern Europe.
I think you just met me, but I'm still Jeff and Head of Capital Markets for Cushman Wakefield.
Excellent. Very good. Let's just start, I suppose, because we're picking up on future trends, that are driving the markets. Let's start with you, Angelos. Just in terms of the retail side, we've obviously heard, there's been negative views on retail, not food retail, of course, or retail parks necessarily. What's your sense of that, and particularly for the region here?
Well, Richard, first of all, I think to keep in mind, before the pandemic, we already saw some developments in the market that were perhaps overlaid by COVID, but in terms of retail real estate, just came back on to the agenda. And that's for sure digitalization, that's the ESG thing, and so on. And also a change of customer behavior. And I think that is now coming back to the agenda. And we've seen this also, I think, in the transaction volume of retail real estate, that coming tremendously upon everyone's mind of the investors. Thing is, retail will change, retail ever changed, but retail is not dead, to be honest. Of course, we will see a new type of retail park. We will see new types of shopping centers in terms of the tenant mix, say, perhaps less fashion-dominated. I know that in CEE that's still a very dominant one, but I think it's only a time like 3, 5, perhaps 7 years ahead that we will see more mixed-use objects in retail real estate. And of course, I'm a food retailer, but not only for that. Many of the current existing retail assets will have a new food or near food-oriented footfall anchor in. And that's also one of the things. We got some brokers here. I think that's also a core investment product of the future for investors. And I think that's where the retail landscape will change. But I'm not convinced that retail only will be in a digital way, that we're only looking for e-commerce and online, but we will have experience in our towns, in our shopping centers, and of course our retail parks, and happy to contribute as a food retailer to that.
Okay, great. And Adrian, obviously, largely an office developer, and I can see a development right next door to here as well. I can see the Skanska signs for that. It would be interesting to get, I suppose, whether or not there's a view in terms of the future of office as well, particularly here for the region. Is it having that moment where it's now got to, like retail, be suddenly very attractive? It's not just good enough that it's a place for people to go and work. It's actually got to be where somebody wants to go and work. I suppose, what are the key drivers for that? And I suppose, how do you see the office sector going forward here?
Thanks. Thanks also, Jeff, for the presentation, which was really interesting. And I looked jealously at Robert. However, as Skanska, as you know, we are office developer, and what is happening with us right now is that we are like this big animal. So we are not taking opportunities. We were looking at the logistic market, but we are kind of sticking to our major activity, and of course we see a lot of opportunities ahead of us. And basically, of course, the factors which were discussed at length today, the ESG, have been in our, let's say, reporting, in our all of the financials from 2008, transferring into really like hard numbers next to the financial profits in 2019. So we are very much focused on that, and this is our huge advantage. So as you have seen also today, the presentation about stranded assets. Yes. So what will happen on the market in the future? There will be lots of money to be looked at to somehow invest or really like change the function of some of the office buildings. We are in this position that we'll be producing this sustainable future-proof assets. Yes, where looking at, of course, the demand, I can say that we have over the last these 2 years we have started 7 projects in Central Europe. We sold almost like 7-8 projects as well, and right now we see. I think the pandemic was a bigger hit than the situation right now in terms of the demand for offices, because looking at the costs which are affecting all of us, where we think the increase of cost of constructions was like 30% over the course of last 2 years. So tenants, we see 2 things happening. First, if they have options to take space, they take space. Yes, it's of course we spoke about pharmaceutical industry, IT industry. We see that in major Polish towns, Poznań, Kraków, Warsaw, where companies are really taking the opportunity to sign now because they kind of see that in let's say 1 year, 2 years, that the rents will be higher. Because of what Jeff you just shown, there's like no supply for the next 2 years, and of course the companies are growing and they will need ESG compliance space. Yes, we're talking about these different governances, but definitely it's coming from tenants that they are pushing that agenda forward, and they will not accept any type of non-ESG compliance space. So taking this into account, we are quite positive. One more factor which is happening, which is interesting right now, it's actually we have more and more requirements from tenants to buy buildings. So usually, we are running these processes, open tenders, getting offers, and then sending all of the different marketing materials to investors. Right now, we see that in the construction phase, when we are discussing leases, especially with these big tenants, looking at the, let's say, majority of the space in a given building, they are sending these questions like, hey, okay, can we start in parallel, or even they are transferring to straight to acquisition mode. So we have the situation right now in Hungary, in Romania, and also we had questions on that in Poland. So yeah, I mean, of course, the situation is very difficult. We have, as we spoke, supply chain disruption and cost increases. But again, as Skanska, we are a long-term player, not opportunistic. In one aspect, we are opportunistic in ESG. So this is something which we, invested a lot, 20 years ago, and I think this is what, will take us further.
Okay, good. Robert, obviously you've been looking at the market for a long period of time. I suppose, how do you see the market at the moment? What are you investing in? Where do you see this at the moment?
Yeah, I think now is a really good time to do nothing, actually, and just have a think about what it is we all should be doing, because as we heard this morning, I mean, it's a pretty opaque world out there, right? From an investor's point of view, you can't see anything clearly. We don't know what's going to happen politically. We don't know what's going to happen with cost price inflation. We don't even know if you can get the stuff you need to build things with. I mean, we're building an office in Barcelona at the moment, and 3 of these steel refineries have shut down because they can't pay for the energy to make the steel. So it's not a question of price, it's a question of actually having the rebar to make the buildings. So, there are so many opaque things out there at the moment that make investing in real estate, in all of Europe, by the way, I'm not talking about Central Europe, I'm talking about all of Europe, very, very difficult. Now, clearly, the 2 big sectors we've all been looking at is logistics and residential. And they're the ones that we've been focusing on a lot, like everybody else. But even in those, and what I can guarantee, one thing I can guarantee is that Robert won't be negative about the logistics market. But I mean, when you look at the statistics for logistics and the yields that people are now paying for things, it's again, it's quite difficult to know where the movement is going to be if interest rates go up and you're paying 3% for a load of sheds. I mean, that's the reality of an investor's world. And I think now is a really good time to breathe, have a think about some things, watch TV a bit, and not do any investing, and perhaps just wait and see how things turn out over the next few months.
Okay, interesting. Assem, it would be good to get your view both on the obviously you weren't here for us this morning on ESG, and also on the interesting to pick up on your views on the future of office, because obviously for any for any finance institution, a lot of your book is going to be on the office side. So how do you see that, I suppose, and I guess it would also be useful for everybody here just to see how you view I suppose Poland, where you're active, versus some of the other markets. I say.
Okay, the last half of the sentence was swallowed. Poland versus
Poland versus the other markets that you're active in Western Europe.
Okay. I think for us it's not the time to do nothing. We're maybe a bit more adventurous. On the one hand, on the other hand, of course, we always take a very cautious view on which projects we position ourselves. Poland, of course, we observe with great care what is happening on the influx of migrants from Ukraine, what is happening on the interest side, inflation, etc. But we still think that, obviously we still think that Poland is one of our strategic markets. We're not present in a whole bunch of countries. We have chosen the countries that we're active in very cautiously, and on the western side, apart from Germany, we're active in the Benelux and France, and on the eastern side, we're basically active only in Poland. And that has some good reasons. It's a very mature economy. It attracts a lot of intelligence. It attracts a lot of entrepreneurial energy, and thus, Poland is obviously not in the same economic position as Germany or France, but it also has some virtues of not being there. And so we look, basically, on a very positive side. When it comes to ESG, I think there are some things that need to be improved in Poland. On the other hand, I think what my co-panelist mentioned, mixed use and etc. We've got some wonderful projects in Poland, particularly in Warsaw, where we already see those kind of mixed-use schemes without really being part of a particular ESG agenda, but just because it's when you rebuild a city or when you rebuild a quarter, then you just automatically go towards what is most agreeable to its inhabitants, and thus there are some very nice schemes such as the Elektrownia project in Warsaw, where we already see that sustainability implemented. The general trends thus are mixed use or inflation protection, value creation through ESG, and that's how we view also the office market. The office market for us remains you're perfectly right, which is a very significant part of our business. And I don't believe that the office sector will disappear or be cut in half. There will be effects, of course, of the mobility of workforce. There will be effects through the technology that we have been used to for the last 2 years. but I think it's like a pendulum. There's some movement in there back and forth, and we will probably see that in a midterm we will see that being in the office will be back en vogue, and we can even see in the U.S. A revival of the office market already that is reported in the press.
Okay, good. Sabina, just coming to you. I suppose in terms of the sectors you mentioned in the presentation earlier, some of the key drivers there, and that was logistics, residential, and life sciences, and those kinds of elements. And this one's cutting out, and I'm just going to borrow that one, Victor, if I can, without anybody possibly noticing that happened. So you've mentioned those, but it'd be interesting just in terms of other key drivers, like for example, digitization, those sorts of larger sort of big drivers for the market. How do you see those? So when you're looking at kind of key drivers overall, the macro drivers, how do you see those, and particularly driving not just the CE markets but markets overall?
Yeah, I mean, I think we like to think of ourselves as structurally driven investors, and we group those in sort of three categories. One is demographics, which is huge. The pandemic has hidden a number of very key turning points in demographics, shrinking of the working age population in China being a key one. The second category is technological innovation. So, the arrival of 5G, the increasing cheapness of advanced robotics, AR, VR, which radically changed the provision of space, because suddenly we all know that retail got radically changed when the supply was magnified infinitely by e-commerce. Office, the supply has increased because now my home is my office and anywhere's my office, thanks to a mobile phone. And now we have the metaverse, right? So the supply of space has radically increased. And the final disruptor we see would be what we would call loosely sort of geopolitical. So as I alluded to in my early presentation, this idea that things that we took for granted have shifted. And in particular, I think people are underplaying the currency change and the payment. I know it's really dull to talk about things like SWIFT and payment systems, but it radically changes people like us who transport capital globally. What does that mean ultimately for our sector calls? We still like logistics and resi, various different types, and new economy, driven by technology and driven by demographics. It means on retail, we're probably a bit more skeptical than my colleague here from Kaufland, for all sorts of reasons. And actually, even on food, this concept that is cold storage now the new retail because of the threat from online grocery. And on office, we do not want to fight behavioural change. And we think actually the sort of office that you guys are developing probably does survive, and it becomes very polarised. So there's the absolutely gorgeous, sexy new office that's there for cultural collaboration and meetings that survives. But commodity office, we would like to hold effectively zero. That's a big shift. So when I joined in 2008, I think over 60% of our portfolios were shopping centres and commodity offices. We started moving that radically about 8 years ago. Probably less quickly than we should have done, but we moved quite quick. Today we're a third, as I said this morning, logistics, residential, new economy. We'll still do some office, we'll still do some retail, but it has to be the best of the best. So it's not a regional strategy. It's what do we think about how consumers want to live, how people want to live. Let's provide that. And whichever market can deliver that to us will be in that market, as long as it has rule of law. Hopefully it's a friendly nation, and we can be sure of our claim to that cash flow.
Great. And Robert, are you going to disappoint by being negative about logistics, or it sounds from what Jeff said that if anything, prices should be higher. So
surprisingly, I'll be positive. Yeah, and obviously we all know the trend, and the recent situation in the market is obviously very dynamic, and the cost inflation is a huge theme also in logistics, obviously, and but demand. What is good about logistics is definitely there is demand. There is a tenant demand, so you have way to go. You have way to recover the cost inflation, and we feel like there is a big room for rental growth, and actually the tenants would have to pay, and they can afford to pay. They were paying not a lot still now, but it's obviously changing rapidly. And I would think that for the next 12 months, the rent in logistic would increase by 20-30% easily. So that's what we feel, that's what we see, that's what we'll do. And so I'm positive. Obviously, each year, each quarter, you need to kind of face new challenges and adjust to the current kind of a situation. And current situation, obviously, is a very short-term uncertainty on the investor side, short-term uncertainty on the contracting side, and obviously a huge cost inflation. But on the positive side, obviously, demand is there, very strong demand. Probably, I mean, even currently, we see that current demand that we are seeing is biggest ever historically, even before the crisis in Ukraine. So it's amazing demand-wise, very challenging cost-wise, supply-wise.
And is this much more in terms of nearshoring and those kinds of things, leading on from, I guess, the shortages that there were initially in the health crisis and now exacerbated by the war in Ukraine?
Yeah, obviously, I mean, nearshoring is one of demand sources, and generally, the mindset changing from a kind of a complete optimization into the safety, into hedge, into be closer to customer. So that's happening, and it's going to happen even further. And right now we are seeing in Poland, in Central Europe, a wave of customers which are obviously moving out of Russia, moving out of Ukraine, and locating in Poland, in Central Europe. So that's another thing, which is also kind of my feeling is that the prices that people were paying for whatever was available on the market, I'm not talking about rents only, were too low, in my opinion. They were having a lot of risk attached to this pricing. I mean, there was. Now it's kind of it's like, I mean, this is the pricing which is risk adjusted right now. Obviously, the supply chains were not diversified, they were too long, and they were having too much risk in it. So currently, we are coming back to the less risky pricing, and I think more sustainable pricing. But you have to face it. You have to face this high pricing. So, but again, the biggest theme in our sector is e-commerce. I mean, it stays the biggest theme, and the demand is obviously enormous.
Okay, good. I'm going to come back to things like data centers in a minute, but Victor, it'd be good just to get your sense, I think, because obviously coming from Romania, you're seeing some of the other markets outside of Poland particularly. So it'd be good to just get your sense of those markets, I suppose, what you're seeing there in terms of activity, and also the sectors as well.
Thanks, Richard. Yeah, indeed, just in sort of some general trends that I can talk about Romania and also some of the other countries, but just to basically two big trends that we're seeing. One is that I agree with Robert's conclusion that a lot of, let's say, Western investors are looking at the markets and grouping things with CEE, and they're very much taking a wait-and-see approach, that's for sure. But at the same time, I think a lot of transactions are still happening. And a lot of those transactions are being performed by those who are already in the markets, maybe particularly Austrian investors, and very much a lot of local capital flexing their muscles now, finally. You have a lot of large groups such as CPI in Czech Republic. You have these Hungarian groups such as Indotech, Adventum, and others. And I've seen, to be honest, no slowdown in sales of transactions. People are pitching for these projects. Yes, and I'm sorry to use this pejorative term, but they're asking for the Ukraine discount on a transaction. But transactions are still happening, and I have not seen really a slowdown at this point on that front. But people are obviously watching very closely what the cost of financing will be and things like that, so there's going to be a further shift. But at the moment, just coming back to Jeff's point, it's still a good deal for Central and Eastern Europe to buy these types of assets. The second big issue that we're seeing, and I think it's sort of connected to the geopolitical presentation that we had earlier. I fully agree with what the gentleman had mentioned earlier, that Poland has really taken a leadership role in this crisis. Romania is very nervous about what's happening. Romania, if you take it into account the marine border, we have the longest border with Ukraine. We have a pro-Romanian government in Republic of Moldova, in a country that is majority Romanian speaking. And, everyone's wondering, is there going to be a pretext to have Ukraine Part 2 and Republic of Moldova and things like that? What does that mean for Romania and other countries in the region? We're certainly seeing along the same lines very much a close relationship with the United States. U.S. investors have also shown a very strong interest in Romania, and this is manifested from particularly on infrastructure. Renewable sector has gone through the roof because Romania is the largest investor in renewables in the CEE region. If you look at the number of projects that are happening, everybody wants to get involved in renewables, so that also has a strong real estate component. And also, what was just discussed now with Robert, what just mentioned, is the nearshoring. A lot of requests coming in from people with existing operations in Russia or elsewhere. It's both industrial, looking to nearshore their industrial operations to Romania, to other countries in CE, particularly Slovakia and Bulgaria. Less so in Hungary, just because Hungary is seen as a little bit less friendly, a bit too close to Putin. And also IT companies as well, which is actually surprisingly driving a lot of the demand for office space, bringing all sorts of engineers from Ukraine, even from Russia and other places, and a lot of companies bringing their operations to CEE. So I think at the moment the market's still robust. It is changing, and we just have to wait and see how this is all going to play out.
Okay, that's interesting. And Jeff, be interesting to get from you as well. I mean, mention there of renewables, but infrastructure. I suppose, are you seeing still lots of different types of investors looking at the region, also geographically? I mean, mention there of the US investors. Are you still seeing, broadly an international group of investors, or is it more local investors? You can take this one.
Yeah, I think the investor universe has changed slightly of the last few months. That translates into slightly less Americans and significantly less Asian capital. In terms of what investors are looking for, there has been a long-term trend towards alternatives. Infrastructure, renewables, I can't comment on because that's not our thing. But alternatives we think about is data centres, is residential. We still consider an alternative, although it will become mainstream. So we see that demand. Although, as a comment on residential for Central Europe, it's tough, and in my opinion, it's unproven. And it's unproven because most of the deals we've seen are forward purchases, so people aren't operating and actually owning this real estate yet. We see a few big players make a big call, which I don't necessarily think is a bad call in terms of the yields that they're getting from their residential real estate, particularly in Poland. However, we see an awful lot of other investors who come and underwrite, and we help them underwrite, and then don't do anything, partly because of product, but mainly because of currency risk. And then compound that with the local interest rates if you finance, or if you're obliged to finance locally, which not many of those investors do actually, most of them are equity. So that's an unknown territory if you're talking about alternatives for us at the minute. Maybe that's because the sort of first wave of it, our firm largely missed, so maybe that's a bit of sour grapes. But I do think there'll be a second wave, but it's going to take its time a little bit, that's my feeling.
Maybe interesting, Sabina, just to get from you, because you're obviously looking at real assets as well as real estate. So that infrastructure side, and particularly things like renewables, I mean, from the conversations that have been had here over the day, I mean, also ESG as a prime function, but also the wish to remove the reliance on oil and gas especially. So is that a key driver, do you think, for those markets going ahead?
Absolutely, and the twin focuses of our infrastructure private equity business is almost entirely either digital infrastructure, some of which obviously overlaps with real estate, so you can argue whether a data center is infra or real estate, and it probably depends on how you're operating it. And the other side of it is renewables, partly because that's what the investors demand, and partly because it's what we want to do. To be fair, the majority of the activity we've done in that space has been more in Western Europe than in the CEE. I'm interested in the comments on Romania, just because that's where, for so many of our investors, and 85% of our capital is core, moving into what they perceive as alternatives, but we just perceive as the core of like 10 years' time, it's often a first mover for them. So the kind of compounding that with low liquidity and a smaller market risk is not for them. So they'll probably stick to Western Europe the first time they do it. But we're hoping that changes, and the way in which we can take them into logistics and office and actually shopping centres and CE is another way we'll be able to take them in for our alternative sectors as well.
Okay, good. I wanted to just pick up a little bit on locations as well. And Angelos, from your point of view as Kaufland, I suppose, where are you looking? Because obviously with food retail, there's, regional cities, for example, are good, but are you then going into smaller, third, sort of, very regional, smaller towns? What's the strategy there?
Well, good news is in all towns you need food. So, generally speaking, just a few words about Kaufland. We're running hypermarkets, supermarkets, from approximately 2,500 square meters of sales area. So we need a minimum town size of about 10,000, 15,000 people and a catchment area of about 25 to 30,000 people. And looking at Germany and the CE region where we are operating, there is a lot of space to go. So generally speaking, how do we deal with that? When we are looking at locations, it's all about flexibility. In the metropolis, you have to be more and more flexible in terms of how you build your hypers and where you build it. So that means we have very flexible concept in terms of parking facilities on the ground floor and the sales area on the upper floor. And also with regard to mixed use, well, the sky is open. We have Resi on top of our hypers. We recently opened a supermarket in Białystok here in Poland where 13-story Resi is on top of our hypermarket. So the more you go into metropolis, the more flexible you have to be. And at the other hand, there are a lot of rural areas also with a centrality of the town, where it's also in the steps where we do expanding, it's favorable for us to be one of the biggest players in food retailing in town. That's obviously the aim then, because then we can get the whole catchment area and guarantee also to figure out our role, as we say, as a footfall anchor for the town. So for us, the expansion will be all about flexibility. We can do it as a freestanding hyper. Obviously, it works, of course. But we can also do more flexible things, also in collaboration with the real estate industry, say as a tenant, for instance. So mixed use we won't do normally on our own, perhaps to such an extent, but as a partner of the real estate industry voluntarily.
Okay, good. Asim, I just wanted to pick up with you on the ESG side. If, for example, there are people here who are looking to either finance or finance particularly things like transitions, maybe less in terms of the larger offices here, but certainly in terms of some of the standing assets where instead of demolishing, there's very much that view to build from that. What's your sense of that in the financing side? What are you financing? What aren't you financing, I suppose?
Yes, thank you. That is perfectly correct. We do have an accent on ESG compliant finance. We offer green finance to our clients, and we also issue, as you know, since quite a while now, green bonds of various classes. ESG compliant offices usually, and to a very large extent in Poland, are new offices, of course, newly built offices which are green then. But you're perfectly right when it comes to other jurisdictions than Poland. The transformation of existing building into ESG compliance is a major issue. For Poland, it's a bit different because the stock is much newer than in older economies, but it will be an issue soon, I would think. So the transformation of offices is something which we are trying to accompany as well in favorable financing conditions. because obviously the climate change, the struggle against climate change will be fought in the existing stock and not with newly built offices. And secondly, because also EU taxonomy will eventually also sanction the embodied carbon in resources that are being used for newly built offices, newly built buildings more in general. So yes, we are trying to have a very constructive approach to transformation of brown to green buildings, and in that, in other words, accompanying an extensive capex program for optimizing the energetic performance of the building.
Okay, good. Robert, I wanted to pick up with you as well, just in terms of that, the ESG side, which we were talking about earlier. I guess from the logistics side, that can be solar roofs, that can be, other aspects. But I suppose, what are you being asked to put in, or what are you being put in to help drive that? And I suppose, are there challenges, opportunities there?
Obviously, currently ESG and certification at a very high standard is a market standard currently, and so you do it by default in all buildings without kind of a tenant request. But sometimes there are specific requests to go above that, and specific items that you put on top of it. But we currently are installing. We are certifying all the buildings with the highest standards. And there is no other way currently, and a building without certificate currently is treated as a kind of a value-add acquisition. So you have to have it, obviously, in order to kind of have a Class A standard building. And obviously some tenants like Amazon, like big corporates, are having even sharper requirements, and then do it on a build-to-suit basis above that standard, which is very high anyway.
Okay, good. Does anybody have any questions? I've got thousands, but we're all here, and there's not many opportunities to have this group of people gathered together. So if you've got any questions, do just raise your hand, and I'll notice them over the next sort of 5 minutes or so. And Richard, if you've got anything, do feel free to drop in. I wanted to pick up, Robert, with you. I know that obviously you're not going to be doing anything except watching TV for the next...
I need to resign so I can watch more TV, actually.
Little while. But I suppose in terms of the broader trends, when you're looking forward, you mentioned residential, you mentioned logistics. Do you also see things like... senior living, student housing, healthcare, life sciences, data centres, those kinds of areas as potentially attractive going forward?
Yeah, well, definitely senior living and anything in the residential umbrella we would be interested in. Data centres, no, don't understand it. Not going to do it probably for a while until we hire someone who knows what they're talking about. But certainly the living sector is of interest to us. I think we've done some senior living in Denmark, and we're looking at some in other parts of the world. But you have to be clear about what part of senior living you're doing. Again, it's another one of these multifaceted words, which means millions of things. But you've got to be clear about what you want to do as an investor. But I think that logistics and resi are the two big sectors that we've been looking at. We're really interested in the office retrofit sector too. Again, it's something that we've been doing for 20 years, office retrofits. Now you need to do it under a different guise and with different acronyms and different ways of doing it. But, if you look at London on itself, we've talked a lot about ESG here today already, but London itself is 80% of the office buildings will be stranded in London from an ESG perspective. So there's a lot of work to be done there. And that's not just changing the light bulbs, by the way. That's getting in and changing the energy source and probably doing something with the fabric of the building, i.e. the windows or the insulation. And that's expensive and hard. And that's tough. That's real tough stuff. And a lot of investors today own buildings which will be stranded, and they don't know what to do with them because they don't have a development team. And you're going to need a development team. So this is where people like Skanska could probably, they'll be useful people to know coming forward because that sort of work is heavy lifting work, and it's all got to be done if we're actually going to make a difference to this problem that we have.
I can add to that. I think you're right. They'll need a development team or people who know how to actually do that real heavy lifting. They'll also need someone who knows how to finance it, because a lot of people will not be able to afford to do this with their equity. They'll have to get financing, and a lot of conventional lenders don't understand how to underwrite that stuff, which is why I think having specialist credit lenders is going to be really important. They're going to have a part to play in this gigantic social project that we're embarking upon.
So it's
I'll give you my telephone number.
I was going to say, it's beginning to look like very positive news for Adrian and Asem. You wanted to pick that up, Jack?
I was just going to also add, you also need a lot of sellers who are prepared to accept that their building is worth a certain price given the expense of what Rob has just described you've got to do to the building. And I don't think we're quite there yet.
Yeah, Jeff, that's exactly right. And, we're not there yet at all, and that's why you haven't seen we talked about it a bit this morning, valuations are backward looking, right? And you really need to look forward to see that actually valuations are not what everyone thinks they probably are, especially in the office sector, because it's going to cost a lot to do what's needed, and that price has not been found yet.
But you are seeing it a little bit in the listed market, particularly in the US gateway office markets, where they have a lot of really crappy 80s and 90s towers that are just, I'm not sure it's economic to do anything to them. So that's where you're starting to see that pain show. But you're right, in the private markets, it'll be a long time coming.
Great. And there was a question up there as well, yeah.
Yes, I have a question to Asem and to what Sabina said before about the financing. Can you quantify the advantage to get a green building finance in comparison to a brown building?
Should I go?
Yeah.
Okay, usually I would have said we usually grant a 10 bips discount on the margin for green buildings investments and the same way on transformation. But I think having said this, and we still do that, we'll basically just try to offer the best possible way to finance these transactions. But what you've got to understand also is that banking regulation throughout the European Union will push banks to actually less like the brown building, let's put it this way, and thus funding costs will increase for ESG non-compliant buildings, and in particular, of course, having in mind the risk that we just mentioned on the panel, the reletting risk. A lot of tenants, big institutional tenants, will not take any brown leases anymore, or the environmental risk, the reputational risk, etc., etc., etc. It will just be in an increasing evolution where it will be more and more difficult to fund those brown assets. And it would be the best to have a green story, if it's not green already, but a green story for the building that you want to present to your bank. Having said this, again, I will emphasize this point. Of course, we cannot only finance green buildings. So the transition and the transformation of building is a necessity, and I think it's also a responsibility for the banking sector, for the financial sector, to accompany this evolution. And it will also require some, let's say, more flexible thinking of the usual banker when it comes to cash flow, which will be interrupted because you will empty the building and then you will do the works to take the capex, and then you will relet the building. I'm convinced that if you offer a modern ESG compliant and if possible EU taxonomy compliant building to let, then you'll probably be in a good position to get the optimum rental income.
Great. Adrian, you wanted to come in?
Yes, if I can. Sabina, a question to you. Again, coming back to this nearshoring, when we look from the global perspective, we had this transformation to global economy, especially driven by US, And now we have a total disruption of this global economy. We have this lockdown now again in China. All of the containers are stuck. That basically you cannot move goods from major exporter, which is China. And now, at least I see this that U.S. is, American politics is that they probably will try to secure supply chains from friendly countries. So how do you see that happening? What kind of impact it may have on Central Europe? I'm not talking only about Poland, but how, what can happen on a global scale? How this can be, impacted when, China will be a bit, going down in their importance.
Yeah, I think, who was it that made the important point earlier that on the one hand, you can move your manufacturing capability from China to Vietnam, which many people did when the sanctions first came or the trade war first started between Trump's America and China. So at that point, supply diversified out of China to other cheaper parts of Southeast Asia. I think the first reaction we all think with this is, okay, so we now diversify out of Southeast Asia back towards part of Europe and parts of the US. But we are seeing a revolution in advanced robotics, right? So it's not just about the cheapness of labor, it's also about whether I can have it actually even closer. Mm-hmm. And then limit my transport mileage, which has an ESG impact too. So the first reaction is always that CE should really benefit from this. And everything I took from Marek's speech is that we are poised to see, great investment dollars coming this way. But you must also then combine the technological disruption, which I think is a real unknown. I think one of the big issues we haven't discussed today is going to be shipping route security. You look at the volume of goods that come through the Malacca Straits, and if you want to get really kind of into the future and real disruptors to logistics, which so far has been radically sheltered from technological disruption really, what happens when you start seeing drone delivery become a norm? What happens when you start seeing automated convoys delivering so that logistics routes are disrupted because you don't need drivers to stop here, there and everywhere and make the package smaller and smaller? And what happens when the Bering Straits become navigable year-round because of climate change? So to me, the whole concept of where do you locate your manufacturing facility is about to hit radical technological and climate disruption that will make what happened to retail look like a tea party.
On that positive note, Robert.
Well, it is positive if you can invest for it and get it right. I think it is positive. It is an opportunity.
Interesting to see, Robert, what are you, and also are you looking at areas like data centers, for example, which has been kind of seen as reverse logistics in some ways. It's just putting something different into a shed to a certain extent. But how are you seeing that? And I suppose, what do you see when you're looking at, obviously at the moment there's lots of blue sky and sunshine, but I suppose what are you looking at in terms of challenges that you're looking at, when you're thinking about the more medium-term future, like Sabina's looking at?
Obviously, if you have to find something to be worried, you think about. But clearly, in the midterm, it's hard to see kind of any negatives. In the long term, it's hard to predict long term. That's how we are looking at things. So we are not thinking about this type of horizon because nobody knows which way it's going to go. But you're right. On top of kind of e-commerce, nearshoring, logistics, we also see a lot of demand from data center occupiers, data center operators. And for us as a kind of development company, there is not much difference, as you say. We would build data center, no problem. And usually, it's not so much volume as e-commerce volume, but obviously the clients they can afford much more than the regular client we have. But they have a very selective criteria, location criteria, power criteria. Real estate itself is not the biggest component of the cost. So obviously there is a kind of a pricing flexibility, but you have to have the right product for the data center operator. So we're doing quite a lot of data centers around Europe, and that's a growing part of what we do. But still, it's a small fraction of the whole volume we develop in Europe and globally.
Okay, good.
May I ask a question?
Sure.
Is there anything that you could call a green or ESG compliant data center? I don't think so.
No, I guess, I mean, my view is it's a different use of the building, but it's a use, and you can use green energy, or you can have traditional energy. So I guess you do the same certifications as in a normal kind of a logistic building. So yeah, and it's obviously much more energy consumption. This building is consuming much more energy, so you have probably wider scope of green areas to cover.
Yeah. Yeah. Yes, absolutely. Scandinavia is really interesting. Richard is just going to reach you with the microphone. But slowly, as it turns out.
Now, just to add to Robert's point, is one of the things we're seeing in Scandinavia is that they're actually taking the heat generated from the data centers and actually then heating residential buildings nearby. So that obviously helps.
Great, good. I wanted to pick up with you, Victor, just because there's a lot of discussion around senior living, and obviously there, Robert mentioned that as well. Those kinds of areas, senior living, healthcare, is that a growth area, or is that too small at the moment in terms of areas like Romania?
At the moment, I think these types of ultra-specialized asset classes, as you move further east, we don't really have them yet, to be honest, at the kind of scale or the kind of quality that the institutional investors are looking at. I mean, PRS for instance, is largely non-existent in Romania, and in Bulgaria, Serbia, for instance, although there are some developers looking at it. Data centers, the same thing. Some investors are starting to to develop them, but again, it's very, very early stages. And senior living homes, another asset class that's just been largely ignored. Again, some people are trying to do it, but at the moment, we're not there yet.
Okay, good.
I have a question actually for Robert. You're an American developer, but many people see you as a Polish developer, which has gone international. And I just want to change, because usually it's like Western developers commenting on Poland, Central Europe. From your perspective, because you've gone to Western Europe, you've gone to Spain and Germany, UK. What have you observed? Are they very different markets to this market? Are they less dynamic, or is that? What are your impressions?
You mean today or in general?
Sorry?
Today or in general?
In warehouse and logistics.
In general, kind of overall.
Overall, yeah.
Yeah. Well, each market has different dynamics in terms of supply, demand, and different kind of a function in the supply chain too. I mean, UK is clearly kind of a consumption market. Germany is it's a country located in the central of Europe. You have ports, you have production, you have consumption, you have proximity of Central Europe. So each market is obviously different in terms of kind of a tenant demand, dynamic supply demand. There are some places in Europe which are easier land-wise, access to land-wise. There are some tighter markets. So each market is obviously different. And the Nordics are also consumption-driven markets. Spain...
so when you say consumption-driven, how different to Poland in that sense?
Poland is obviously a production market. It's a kind of serving also e-commerce-wise itself, but also Germany. So you have different type of use in Poland, right? Where similar to Poland is, I would say, Spain, which is a bit production, a bit consumption, but also serving France, which France is very tight market in terms of land and permitting, and it has to be served from other places to kind of fulfill the need of France. But we still develop in France too, but it's much harder work than in Spain, for instance. So Europe is a kind of a set of different situations. Obviously, Western Europe is more liquid than Central Europe. Different parameters in terms of fields, rents. Germany is tight, especially Western and Southern Germany is much tighter than the rest of Germany in terms of land acquisition, land supply. So different things. And it's hard to say. It's hard to say there is
Can I ask Robert a question? So this amazing demand story and the fact that rents should go up strongly, the tenants can afford to pay. Do you see that across your European holdings, not just in Poland?
Yes, I think the Poland is joining the party last right now, because of historical kind of probably less supply constrained market, but it's coming because of the construction costs going up, substantially going up, substantially going up. So it is happening in Poland. Western Europe is much tighter, it's much more bureaucratic, permitting, access to land. So it is happening much earlier than in Poland. But it's I mean, you would see that. I mean, you probably are seeing it. I mean, you have large portfolios, so.
And this is my last question. This is a serious question. Other sectors are sort of joking. They're looking at the warehouse and logistics sector because it's the most dominant one. Do you look at any other sector outside warehouse and logistics thinking, maybe there's a opportunity there?
If I would have time. No. No, I guess, obviously, no, we are not looking. We are growing geographically, but in our sector.
Okay, thank you.
Great. And just maybe a final one for everybody, which is just when we're meeting here next year at the same time, where do we think we'll be then? Where we'll be looking forward to? You can either take that as a personal thing or as a business thing. When we discuss this again, and I say, what did you do over that period? What will it be? I suppose that's the question. So, what will we be investing in? Where will we be seeing the opportunities? When we've had our rest in front of the television, what will we be doing? Let's start with you, Jeff, and we'll work our way around.
In 12 months, I think in Central Europe, residential will be a little bit more active again, and I think in the meantime will be less so. And I think retail is already showing signs of liquidity, as we've mentioned. And I think that will gain momentum as well. The other sectors will probably keep their status as to where they are. That's my feeling.
Okay.
Very hard to look in the crystal ball on this one, but especially with how the cost of financing and the construction costs will look over the next 12 months. But I really think that coming back to Adrian's point about the fragmentation of the globalization the situation we've had until now, the nearshoring, more opportunities generated by bringing back production to Central Eastern Europe, whether that be light production, full-scale production, services, everything else. I think a lot of countries are realizing now that they can't rely necessarily on far-flung places to do their work. So the real estate, the work that's being generated by that, I think is in 12 months you're going to see a lot more.
I think in 12 months the uncertainty that we have right now will go away. That's my view. What we'll see probably, as I said before, the rent would grow by 20-30%. The vacancy would go close to zero. And there'll be much less players than it is right now. There'll be a bit of consolidation on the way because it's obviously a very challenging time in terms of supply and cost. And so you need to watch your balance sheet.
Okay, great. SM.
Retail and office will still be alive. I will still not understand how logistics can be so expensive. And I think there will be, to a certain extent, a diversification in the lending sector, meaning that the private debt coming from debt funds will take a part of the banking sector, having in mind that banking regulation will have a restrictive effect on banks.
Okay, great. Sabina.
I think in 12 months' time, the pain with the consumers will still be there, if not increasing, because of what's going to happen with food production this summer. And so what we thought might have been the recovery in retail and value discovery won't quite have been there yet. I think we'll be seeing some of the private market pain in office that we think is coming manifesting, and maybe a few selective opportunities there if it becomes broad brush. I think logistics will still be very, very hot. We'll be doing a lot of that. And I would like to think that we all collectively will be really looking with interest at investing in Poland as this new amazing leader and hub in CE, and looking potentially at rebuilding Ukraine, because I would imagine whatever is going on now, though it might go on a bit longer, will hopefully be over by then, and we as an industry will be part of that solution.
Great, Robert.
I think that the serviced office sector is really going to come into its own. I think post-pandemic, I mean, I was a skeptic before the pandemic about the serviced office sector, but I think post-pandemic, it's proved its business case. And I think office occupiers are going to want that sort of flexibility. So I think that we will find that is going to be one of the major office occupiers.
Great, Adrian.
Yeah, I have to agree. But on a global scale, I believe that 12 months from now, the winning countries, countries winning business will be those who will be adapting quickly. Yes, and again, I see a huge potential in our region. Yes, because we have had 45 years of communism. We had to adapt to a totally different environment, and we are going through a very difficult time again. But I think the experience and examples are like we have had in the past. Yes, we are coming out stronger as a countries in Central Europe out of any of such crises, and I think we'll be winning next year. And in terms of the product, I would add to what you said, Robert. I would add service office, but in a combination. So meaning office next to PRS. Yes, this is my take, with the complemented with this service offices.
Angelos.
Well, just with a sharp note on the asset class retail, perhaps, I agree with Jeff. We will see, generally spoken, more liquidity in the retail class retail. That brings more opportunities to the market, that are definitely more value-add products, where you can bring in a new tenant mix, as I already mentioned. We'll see a reurbanization of our cities, a restructuring of our cities, which brings also more opportunities perhaps than we think right now, when you're only thinking CLOs like office and so on. But we will have to adapt to that, and I'm sure, thanks Assam, yes, retail is not that, but it will change for sure. We will see more e-commerce, but we will also see a new retail landscape, and I guess food will play one of the major roles in that, and happy to looking forward to that situation there.
Great, thanks very much. Really interesting discussion. Fantastic to have everybody here. Thank you for joining us online as well, Assem. And the next session is just going to be a sort of take on the day, really, from Hadley, Monica, and Marcus. So to be very efficient with our applause, we're going to be thanking the panel here and welcoming Marcus and Hadley and Monica. Thanks very much. Really interesting. Great for joining us. Thank you.